In this tutorial, I'm going to walk through with you exactly how to use the Seasonax Screener function in order to find the strongest seasonal trading opportunities in just a few clicks. Then I'm going to show you how to interpret two of arguably the most important metrics, the standard deviation and the Sharpe ratio, which is going to help tell you just how profitable and reliable a pattern is. So what does the screener do, first of all? Well, the Seasonax Screener allows you to scan an entire market and instantly identify the most statistically robust seasonal patterns. So instead of just, checking symbols one at a time, what you can do, Seasonax will check all the symbols together and rank all the instruments for you based on historical performance, consistency, and risk-adjusted returns. So let me just talk you through how to use it. So step one, right, you would choose your market. And you can see in this example, we've chosen the Dow Jones Industrial Average. But you could choose lots of different markets, from the European indices, commodities, currencies. You have a whole variety of options. In this instance, we're going to choose the Dow Jones Industrial Average. Now what we're doing is we're scanning all the companies in the Dow Jones Industrial Average. So next we want to set the start date. And this tells us when we start analyzing seasonal behavior. So when we click the 25th of November, or 26th of November, we're saying, okay, Seasonax, we want you to screen the seasonal behavior from this date onwards. Now we want to check the examination period. Now for the examination period, an examination period of 10 years is statistically significant. If you were looking for something just in the very near term, you might look at 3 to 5 years, but generally you want to be looking at something 10 years and above, and 10 years is a great place to start. So we're looking for a seasonal pattern over a 10-year period. Then we select the time period. So here we're searching for seasonal patterns between 5 and 30 days. Okay, if we want to have it longer, we have 31 to 60, 61 to 90. But in this instance, we're going to look for seasonal patterns between 5 and 30 days. Next, we have the option to apply a filter win percentage. So let's say, for instance, we want to filter the win percentage to 70%. And straight away, you can see that we now have 10 eligible components of the Dow Jones Industrial Average. Then we decide whether we want to go long or short. This gives us the option of whether we're looking for an upward bias or a sell bias. We can use that here. Now, let's understand the screener's results. So, when the filters are applied, as we've applied them up here, Seasonax gives this a ranked list of seasonal opportunities. And each row here represents a seasonal pattern. And the key columns include things like the annualized return. Now this extrapolates the seasonal return over a full year to show how strong the seasonal effect is. So you can see here with the United Health Group, it's got a really strong annualized return, which tells you that it's a very strong seasonal pattern. And if it's extrapolated over the year, you can see what sort of returns it gives. We then look at the average and the median return. The average and median return shows a typical performance of the pattern. The median is especially useful because it can help remove the effect of outliers. You're just looking at the number in the middle, that middle number, and that can help just filter out those extremes to the upside or to the downside of the pattern. The pattern start and end date, that's anchored to the options we gave above. And you can see here, you also have the calendar days. This tells you, right, how many calendar days are in the pattern. The max profit and max loss tells you the best and worst outcomes during the seasonal window across its history. So you can see the maximum profit, this is the best outcome. The maximum loss, this is the worst outcome. We then have number of winners out of the trades, and you have the win ratio. So 8 winning trades out of 10 trades, it's obvious to see that's an 80% win ratio. 7 winning trades here out of 10 trades in total gives us a 70% winning ratio. That's relatively easy to understand. 2 metrics that aren't obvious on face value to most people is the standard deviation and the Sharpe ratio. Now these 2 components tell you how reliable the pattern is. So we're going to break them down in a little bit of detail next. So what the standard deviation does is it shows you how spread out the historical returns are. It's a measure of consistency of the pattern, not profitability in and of itself. So what you want here is a low standard deviation, because a low number is indicating that the returns are more predictable and more stable. If it's a high number, in other words, if the returns are widely spread out, it means it's a potentially volatile and inconsistent pattern. Now, the reason this is important, because you might have 2 stocks that have a very similar average return, but one could have a very low standard deviation. In other words, those returns are consistent and reliable, whereas the other stock might have a really high standard deviation. So in other words, okay, one year it was plus 14%, the next year it was minus 16%, then it was plus 8%, then it was minus 4%, whereas one stock might be, it was on average, plus 3%, plus 5%, plus 4.5%, much more reliable and consistent. So what you're looking for here is a low number, because a lower number indicates greater consistency. And it's really essential, this standard deviation metric, for identifying patterns that are repeatable rather than just sort of random. It helps you understand how spread out those returns are. Then we also have the Sharpe ratio. Arguably, it's the single best quality score in the screener, because what the Sharpe ratio tells you is how much return you're getting per unit of risk. It's a way of measuring the return versus the risk you've put on the table. So a pattern with a very high Sharpe ratio is telling you that, the return you're getting for the risk is good. So you want the Sharpe ratio to be a high number. So straight away we can see that, looking at this, United Health Group, it's got a relatively low standard deviation and a high Sharpe ratio and a high winning trade percentage. So when we click on it and we look at the returns in more detail, we can see, look, the downside is really, really limited. Just the maximum loss is negative 1.06%, and there have been some steady years over 4%, and over 2% in 1, 2, 3, 4, nearly 5 years. So putting it all together, the strongest seasonal setups are ones where you've got everything aligning. High win rate, strong average return, you want low standard deviation, high Sharpe ratio, that clear historical stability. So they're the kind of features that Seasonax allows you to do. And the Seasonax Screener, it's just one of the fastest ways to uncover reliable, data-driven trading opportunities in seconds. By filtering the market and using metrics like the standard deviation, the Sharpe ratio, you can quickly distinguish between patterns that are genuinely powerful and those that maybe only look good on paper but aren't so good in reality. So you can use Seasonax's tools to build a seasonal trading routine that is objective, repeatable, and most importantly, statistically grounded.